There is a question that sits underneath almost every conversation about why some traders make it and most don't. It requires a trader to look at something about themselves that is harder to examine than a chart, harder to measure than a win rate, and harder to change than a strategy. But it is the question that once asked seriously and answered honestly tends to reorganize everything a trader thought they understood about why they've been struggling. The question is this: what does trading mean to you? Not what you want it to produce, not the lifestyle it might eventually fund. What does the act of trading itself mean to you at a level you've probably never put into words? What does a win confirm about you? What does a loss threaten? What does sitting in a losing trade feel like, not financially, but personally? What version of yourself are you trying to prove exists through your performance in the market? Most traders have never asked those questions, and the traders who haven't asked them are almost without exception being run by the answers without knowing it. This video is not going to give you a list of psychological tips. It is not going to tell you to meditate, journal, or breathe before you trade. What it's going to do is something more specific and I think more useful. It's going to diagnose precisely and honestly the psychological mechanism that separates the traders who eventually achieve consistent performance from the much larger group that never does. And it is going to do that diagnosis in a way that requires you to apply it to yourself, not to some abstract trader archetype. Let's start with what psychology in trading actually is. Because most people in this space use the word without understanding what they're pointing at when trading psychology content talks about psychology. It almost always means something behavioral: control your emotions. Follow your rules, don't revenge trade. These are behavioral prescriptions, instructions about what to do and what not to do. They're not wrong, but they are describing the surface of something much deeper and treating the surface. As the whole picture is exactly why most psychological work traders don't produce lasting change. Real psychology, the kind that clinical work and serious performance research actually engages with, goes beneath behavior to the level of meaning. Not what you do, but why what you do feels necessary. Not what your emotions are, but what they're protecting. Not what rules you break, but what breaking those rules is actually serving at a level below conscious awareness. Here's a concrete illustration of the difference. Two traders break the same rule. Trader A moves their stop loss on a losing position and eventually gets stopped out for a larger loss than their plan intended. Trader B does exactly the same thing. The behavior is identical, but the psychological meaning behind the behavior is completely different. Trader A moves the stop because they are afraid of being wrong. The loss, if taken at the plan level, would confirm something they already fear about themselves: that they don't have what it takes, that their judgment is unreliable, that they're not as capable as they believed when they got into this. Moving the stop is not a trading decision, it is an unconscious attempt to delay a verdict. Trader B moves the stop because they have a deep, long-standing pattern of believing that persistence will eventually be rewarded if they just hold on long enough. It's a pattern that has served them in other areas of life. It worked in their career, it worked when they learned other skills. The market, they believe at some deep level, will eventually respond the same way if they just don't give up. Moving the stop is not a trading decision for them either. It is the expression of a personal narrative about how effort and commitment should eventually overcome adversity. Same behavior, completely different diagnosis. And the reason this distinction matters enormously is that the fix for Trader A and the fix for Trader B are completely different because the source is different. You cannot treat fear of being wrong with the same intervention you use to treat misapplied persistence. And yet almost all trading psychology content addresses both with the same generic instruction. Follow your rules, accept the loss, move on, as if the rule breaking were the problem rather than the symptom. This is the foundational issue with how psychology is discussed in trading. It treats symptoms as causes. And when you treat a symptom as a cause, you can suppress it temporarily through willpower, through structure, through accountability, but you cannot resolve it because the cause is still there untouched, waiting for the next moment of pressure. Here is the first principle that separates winners from losers at the deepest psychological level. And I want to be specific about what I mean by it. The traders who achieve consistent performance have developed what I'd call a working relationship with uncertainty, not a tolerance for it. not a management strategy around it. An actual working relationship, meaning that uncertainty in the context of trading has become something they can operate within clearly and without distress. The same way a surgeon operates calmly in the presence of the uncertainty that every procedure involves. This is psychologically different from what most traders are doing, which is trying to reduce uncertainty to a level they can comfortably operate within. Through more analysis, more confirmation, more indicators, more news watching, more waiting for the trade to feel right. All of these are attempts to close the gap between what is known and what is unknown before committing to action to achieve a level of certainty that trading, by its fundamental nature, can never provide. And the problem with that strategy is not just that it doesn't work, it's that it is self-reinforcing in a direction that progressively makes trading harder. The more a trader trains themselves to wait for certainty before acting, the more their nervous system learns that uncertainty is a threat to be resolved rather than a condition to be worked within. And once uncertainty is encoded as a threat, every moment of genuine market ambiguity, which is constant, triggers a physiological stress response that further impairs the clear thinking and patient execution that trading requires. The traders on the other side of this divide are not people who are naturally fearless about uncertainty. They are people who, through real experience in the market, have built a different cognitive and emotional structure around what uncertainty means in this context. They have internalized, not just intellectually, but at a bodily level, that uncertainty about the outcome of any single trade is completely consistent with a reliable long-term positive expectancy. That not knowing what this trade will do is not a problem to be solved before entering. It is simply the operating condition of a probabilistic profession. That internalization doesn't come from reading about probability. It comes from a specific kind of accumulated market experience where the trader has taken enough trades with enough consistency of process and tracked the outcomes honestly enough that the statistical reality of edge and variance stops being an abstraction and becomes something they have felt personally. Across hundreds of real decisions, it becomes knowledge they carry in their body, not just in their head. This is why no amount of psychological reading, however good, substitutes for the actual experience of executing a process consistently across a large sample of trades. The reading is necessary but insufficient. The embodied knowledge only comes from the doing. Now, I want to stop here and ask you something directly, and I want you to sit with it before you answer. When you're in a live trade and price moves against you, what happens in your body before your mind starts forming thoughts about what to do? Not the thoughts themselves, the physical sensation that arrives first, tightening somewhere, a shift in breathing. An impulse to act that appears before any reasoning has occurred. That physical response is your nervous system's evaluation of what this moment means. And it is happening at a level that your conscious, rule-following mind sits above but cannot fully control without understanding what's driving it. Comment below what that physical sensation actually is for you. One or two words: tightening, heaviness, rush, freeze. Whatever actually happens before the thoughts start, I'm asking. Because naming that physical response honestly is the beginning of understanding what your nervous system has learned to believe about what a losing trade means, and that belief is operating in every single trade you take, whether you're aware of it or not. Here is the second principle. And this one is the one that tends to produce the most resistance when traders first encounter it, because it requires acknowledging something that feels disloyal to the effort they've already put in. Most traders are not failing because they lack skill or knowledge. They are failing because their reason for trading is working against their ability to trade well. Let me be precise about what that means, because the vague version of this idea is everywhere, and it helps nobody. Trading, for the majority of people who come to it, is not just a professional or financial pursuit. It arrives loaded with personal meaning that has nothing to do with markets. For some traders, it is about proving something to themselves, to specific people in their lives, to a broader sense of who they are capable of becoming. For others, it represents escape from a career they find meaningless, from financial constraints that feel suffocating, from a life that hasn't yet matched the version they imagine for themselves. For others, still, it carries the specific weight of a second chance. The feeling that this is the thing that will finally work out after other things haven't, and that failing at this would carry implications about their worth that extend far beyond the money. None of these reasons are shameful. They are human. They are exactly the kind of meaning that drives people toward difficult things that most people won't attempt. but they create a specific psychological problem in the context of trading. And it is this: when the outcome of your trades carries personal meaning beyond financial gain and loss, every loss becomes a threat to something larger than your account. And when a loss threatens your sense of capability, your escape route, or your last best hope, the nervous system responds to it not as a normal expected event within a probabilistic system, which is what it actually is, but as a danger signal. A signal that something important is at risk, something that needs to be protected. And the moment the nervous system identifies a loss as a threat to something personally important, the behavior it produces is not rational risk management. It is protection. It holds the losing trade too long because accepting the loss means accepting the threat's implication. It abandons the process because the process is producing outcomes that feel dangerous. It seeks certainty and confirmation because uncertainty is no longer just financially uncomfortable. It is personally threatening. This is the actual mechanism underneath most of the behavioral problems that trading psychology content describes. Revenge trading is protection from the implication of a loss. Overtrading is an attempt to outrun the meaning that accumulating losses are building. Freezing on valid setups is protection from the risk of another piece of evidence against your capability. The behavior looks like a trading problem. It is a meaning problem. And the reason this diagnosis matters so much is that you cannot fix a meaning problem with a behavioral intervention. You can build systems, rules, checklists, accountability structures, and they will work partially in moderate conditions. But when the pressure increases enough, when the losses stack up enough, when the personal stakes feel high enough, the meaning will override the structure every time. Because the nervous system is faster than the prefrontal cortex. And a nervous system that has learned to interpret trading outcomes as threats to personal identity is not going to be quieted by a checklist. What is required instead, what the traders on the other side of this have developed, whether they could articulate it this way or not, is a genuine separation between trading performance and personal worth, not as an affirmation or a mindset shift or something you say to yourself before a session. As an actual, tested, repeatedly confirmed internal reality, a place inside you that genuinely does not move when a trade loses, not because you don't care about results, you do, and you should, but because the results no longer carry the additional weight of what they say about you as a person. That separation is not built through insight alone. It is built through extended experience of making good decisions in the right process and allowing the statistical reality of that process to gradually demonstrate that your worth as a person is not correlated with what the market does on any given day or week, or even month. It is, in other words, built through exactly the kind of slow, honest, process-focused work that this channel has been discussing across every video in this series, not as a collection of behavioral tips, as a coherent project of developing a genuinely different relationship with what trading outcomes mean. I want to give you one final question before we close, and this one is the hardest one in the entire video. If trading were completely removed from your life tomorrow, not failed at, just quietly removed, what specifically would you lose beyond the financial potential, not the income? The other thing, the thing it represents that you haven't said out loud yet, comment below if you're willing to answer honestly. One sentence, you don't need to explain it, just name it. Because that thing, whatever it is almost certainly the single most influential force operating in your trading right now. More influential than your risk management, more influential than any tip or technique or psychological framework you've ever encountered. And until you can see it clearly, it will keep running your trading from behind the scenes. Here's what genuine psychological development in trading actually looks like, because I think it's important to end this video with something that points toward reality rather than just complexity. It doesn't look like achieving a state of perfect emotional calm. It doesn't look like reaching a point where losses feel like nothing. It doesn't look like finally becoming the robotic, detached executor of a mechanical system that trading mythology sometimes implies is the goal. It looks like a gradually deepening honesty with yourself about what you're bringing to the market every time you sit down, about what you're hoping trading will do for you beyond the financial, about the specific meanings your nervous system has attached to winning and losing, about the gap between the trader you perform as when things are going well and the trader who shows up when they're not. That honesty built over time produces something that behavioral tips alone never produce: genuine self-knowledge at the level where trading decisions are actually made. Not at the level of conscious thought and intention, At the level of the nervous system, split-second evaluation of what each moment means and what it requires in response. The traders who separate themselves from the majority eventually do so, not because they found better information or a superior strategy or a more effective set of rules. They separate themselves because they did the harder and slower work of understanding themselves at the level that trading actually demands, which is deeper than most people are willing to go. And more honest than most people are comfortable being, that is the actual work. Not the tips, the diagnosis. And the reason this video exists and the reason this channel exists is the belief that the traders willing to go that deep, willing to ask the uncomfortable questions and sit with the honest answers are the ones the market has no permanent hold over, because they've stopped fighting the market. They've started learning themselves.